Okay, welcome guys. So basically, we'll be considering the second part of lesson one, right? Which is knowing when to buy and sell. Knowing when to buy and sell. Now, let me start by saying that Forex basically involves trying to bet on which currency is going to fall or rise. That's one. And then there are various ways that you can use to, in quote and unquote, bet on what currency is going to rise and what currency is going to fall. One of the major ways you can do that is through technical analysis, right? Looking at the charts and based on the candlestick pattern or structure, you haven't tested a particular strategy over time, you make a decision on whether the market is going to go up or down. That is bullish or bearish. So you can buy or sell. The second way you can do that, knowing when you can know when to enter a trade, is through economic, or let me use the word fundamental analysis. We would go into this in a much more broader perspective. Fundamental analysis, and this requires the use of economic data and the economic basis of currencies. This requires the use of economic data and the economic base of currencies, okay? Let me just change this to base of currency. Sounds better, even though what I have always known is basis of currency. So the first one is having a strategy, looking at the charts and making a decision about the strategy that you have. The second one is you're looking at economic data, economic reports and all of that, and you're making a decision on whether you're going to buy and sell, or sell rather. Not many brokers encourage hedging, which is buying and selling at the same time, although it's a very, very tricky strategy to use, but some people do it successfully. I don't know how. Never been able to do that successfully. And not, like I said, not many brokers allow that. You can't buy and sell the same currency at the same time in many brokers. Okay? So now the thing is, how do you know when to buy and sell? How do you know when to buy and sell? You could use fundamental analysis, or you can use technical analysis. But in this case, we want to do a bit of, the course is largely built on technical analysis and maybe 20% fundamental analysis, okay? So since the major part of the course is built on technical analysis, let me just start out with fundamental analysis, okay? So in the following examples here, we are going to be going through a little fundamental analysis to help us decide whether to buy or sell a currency pair. And so we are going to start with a term which, of course, some people would know by now. And if you do not, you should know this now. It's called macroeconomics. You don't need to be an economic guru or anything. You don't even need to know you don't need to know any term in economics to trade Forex successfully. I'm just giving you a broad knowledge of fundamental analysis for two reasons. One, so you do not just dive into the market and trying to look for strategies without knowing what really controls the market, what really moves the market. So you have an understanding of what actually moves the market before you start looking at candlesticks. Because if you trade technically alone, even though I'm a technical trader, I still do some fundamental analysis and research. If you trade technically alone, you're going to get burnt because there will be times where the candlesticks are printing buy, and then the economic data is saying that this market is going to tank anytime soon. And if you're not aware of that, maybe by way of news or other forms of fundamental analysis, going through economic data and all of that, you're going to get burnt. So macro and economics is basically all about looking at the big picture of how an entire country's economy works. Okay? That's basically what macroeconomics is. Looking at the big picture of how an entire country's economy works and how it is performing over a big period of time. Okay? So you're basically going to be looking at macroeconomic data. It's simple to do fundamental analysis, funny enough. You could just go on Google and type macroeconomic data for USD, for the United States dollar and the United States economy. And it will show you different things and give you expert analysis on, okay, this is where it is projected to go. This is where the US economy is projected to go. So if there's an outlook on the US economy that is positive, then you know that, okay, some currency pairs that the US dollar is either the base or quote currency of, particularly the majors, would obviously respond to it either by going up or down. And how do they respond to it by going up or down is what we are going to go into next. So first example, we use the USD, the Euro USD. Or should we use my favorite currency pair? Nah, let's use the Euro USD. It is the most traded currency pair in the market. So let's use the Euro USD. So a clear example here is for me to start by saying that each currency belongs to a country or a region, right? So the whole idea of fundamental analysis is to try to understand the overall state of that country's economy, whether it is productive, whether there's a better employment. A very good employment statistics is an indicator of the strength of an economy. A bad employment statistics is an indication of the weakness of a country's economy. So a simple and basic example would be you just go on Google and you type economic employment statistics of the Euro USD of Euro, and then you read about it, and then you type the employment statistics of the dollar, and then you just basically read through it. It gives you an idea when you're coming to the chart, you're not coming blank, particularly if you are not only looking at the technical side of things. It gives you an idea as to this is what I'm looking out for. Okay, the dollar economy is outperforming the euro economy, so I'm expecting a sell in the Euro USD. The reason why you're expecting a sell in the Euro USD is because the euro is the base currency and the dollar is what? Is the quote currency. So if based on your economic data, the dollar is outperforming the euro by way of the American currency is strong and growing and has better employment rate as opposed to the region responsible for using and moving the euro, then you're going to sell. Because what you see on your charts, when you open the Euro USD chart, yeah? Let me write this down. It's important that you take note of this. So when you open a Euro USD chart, what you're seeing is more of a representation of the base currency, which in this case is the euro. So if the American economy is performing well, and I just said that when you open the Euro USD chart, what you are seeing is the euro, what do you think you're going to do? If the American currency is performing well as opposed to the European euro, or the American economy has a better economic index, a positive outlook, as opposed to the European region, right, and the economy of Europe and the countries that basically contribute to the movement of the euro, the movement and the usage of the euro. What do you expect to do in that kind of scenario? You're obviously going to short the euro because the euro is weak. So you sell the euro because it is weak. If the regions responsible for the usage and the movement of the euro currency has a strong economy, a better employment rate and all of that, as opposed to the United States dollar and the United States economy respectively, what do? You're going to buy the Euro USD. That is what it is. You're going to buy the Euro USD. I think I should just paste this here. So how do you know which currency is going to rise and which currency will fall. So you have the Euro USD. The Euro is the base currency, like I said earlier, and that means you look at when you look at your charts, your Euro USD charts, what you see is the price movement of the euro. The euro is largely controlled, right? Is controlled and largely based on the European economy. And the US dollar is largely based on the United States economy, right? So what do you expect? I think we've written this earlier. So what do you expect is going to happen when the United States economy is strong and the euro is weak, or the European Union's economy is weak, or the countries that make up the European Union and use the European Union economy is weak? You're obviously going to sell the euro. Same thing applies for USD JPY. Now, in this case, the US dollar is the base currency. The US dollar is the base currency and the JPY is the quote currency. So if the Japanese economy is relatively stronger and has a better employment rate and other economic factors are in place that makes it have a positive outlook, what we're expecting is that as opposed to the US dollar, right, you are going to short the USD JPY. Why do you do that? Is the same reason I explained earlier. If the chart, when you open the USD JPY chart, what you see in the USD JPY chart is basically a representation of price movement of the US dollar. So if the US economy is weak and the Japanese economy is strong, you're basically going to sell the USD JPY, because what you are seeing is a price representation of the US dollar price movement. So if the US dollar is strong and the Japanese economy relatively to the US dollar is weak, then you're going to buy the USD JPY. Similar thing applies for all the other currencies here. Okay, so now what next? What next do we look at that is important for us to consider? I think you can do the GBP USD and the USD CHF and all the other currencies. You should be able to understand the basics of how fundamental analysis works now. So the next thing we're going to be looking at is lots, trading in lots, right? Trading in lots, right? That's the next thing we're going to be looking at. So now you cannot just go into an egg store and say you want to buy an egg. If you say that, it means, okay, you want to buy an egg, that's just one. But when you go into a grocery store and you want to buy an egg, you can't just say a single egg, right? Although in most shops, particularly in some parts of the world, you have situations where you could just buy a single one, but there's a unit of calculation in Forex trading for the volume of the currency that you want to buy. This would become much more clearer in the future as we go deep into the course. But the lot size is basically the volume, the amount of a particular currency you want to buy, right? In Forex, it would be the way it is placed in Forex here, it would be foolish for you to say, I want to buy €1, because you're not buying a physical currency, remember. You're buying price movement representing the strength and weakness of a currency and an economy. So you cannot just say, I want to buy €1. No. What we measure with the same way you measure an egg in dozen or half a dozen, or you measure water in liters, it's the same way you measure currency pairs in lots, the volume of buying currency pairs in lots. Currency pairs usually come in lots. So there are basically three categories of currency pairs, like currency pair measurements in lots. So you have the micro lots, which is the smallest unit. That is 1,000 units of it. 1,000 units of a currency pair, right? This is important for when you're doing your risk management calculation, but you don't need to really stress yourself about it too, because there are already softwares and websites that have very good and reliable risk management calculators, which I'll share on the group, which is the number one reason why most people blow their accounts: poor risk management. And we would hammer on that later on. So the second, the second category is what you'd call mini lots. Which is 10,000 units of a currency pair. And then you have standard lots. Okay? Which is 100,000 units. If you go to your MetaTrader 5 and you open it and you click on any currency and click on new order, on the middle section on top of your screen in your phone, you're going to find where they have this 0.00 on a line where you have plus 0.01, plus 0.02 and all of that. That is where you impute your lot size. I would send a screenshot of it on the group, right? And see if I can work it into the video. So what you have this as on your MetaTrader is 0.01. This is a mini lot size that you impute when you want to trade with mini lots, right? And then, micro lots. And then you have mini lots as 0.10. Okay? And then you have a standard lot as 1.00. And the measurement of the volume of purchase in currency is known as what? Lot size. And then the measurement of the movement of currency is known in lots. Is known in pips rather. So you have pips. Like I said, there are already websites that help you calculate all of this, right? So you do not need to bother yourself about knowing the mathematical formula or whatsoever, right? So let me just write this down. Or amount of purchase right? And then trading with pips currency pair is known basically as pip. Okay, so now the implication of this is that these two things, when you want to get the exact lot size you're supposed to use in a particular trade, you're supposed to know the pip difference of price, which obviously TradingView is going to help you do that. And then you impute it into your calculator, and then you impute the amount that you want to risk on the trade, and it will give you the lot size you're supposed to use. There will be a practical video on that, I think, in week 4. Okay, there will be a practical video on that in week 4. And so by so doing, we are done. We're almost done with this topic. Now, the next thing that you have to also consider is trading with rollovers. I know this part is boring, but the difference between a profitable Forex trader and a non-profitable Forex trader is the amount of due diligence done in learning and trading Forex. So for positions that you open, let's say you enter a trade and you leave it overnight, right? You're going to pay a fee on it. you're going to pay a fee on it, because obviously your broker is going to charge you a fee for carrying that trade over to the next day above the cutoff time, which is 12 p.m., 12 a.m., 12 p.m., 12 a.m. rather, 11 p.m., 5 p.m. Eastern Time, 11 p.m. GMT, 12 p.m. UTC, and all of that. Okay, so to take the trade to the next day, you're going to be charged a minor amount in terms of percentage interest on that particular trade. Now, it varies from currency pair to currency pair, and some brokers inflate it, some brokers keep it to a standard respectful level. So that's another thing that is important for you to note when you're holding trades. I'm a day trader. I'll come to the different types of traders later. But as a day trader, I open and close my trades all in the same day. The few times where I have decided to hold trade over, I have had more bad experiences than good ones. So that comes to the end of, okay, lesson 2, part 1, and part 2.